This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Right at the very beginning of this chapter, we got introduced to the basic concept of a transfer of value. If there was no transfer of value, there would be no chargeability to IHT. And although we saw that for the vast majority of taxpayers, other than the ones you're going to see in the exam, of course, that the only transfers of value they would ever make would be on their sad demise when they died, what we will see in an exam question is that also taxpayers making transfers of value during their lifetime. We knew how to measure that transfer of value. It wasn't simply, though usually it also equated to, but it wasn't simply the market value of the asset being transferred. It was the loss to the estate of the donor, measured how? By taking the difference between what the taxpayer had before the transfer and what he had after the transfer. But then in all of the examples we've done ever since with those lifetime transfers, where we've seen all the illustrations that gradually we got to know the names of the different types of transfer, being either PETs or CLTs. In every one of those examples, we have referred not to a transfer of value figure for the lifetime transfer, but to a chargeable transfer figure. Now, it may very well be the case that in many situations, the transfer of value is also the same as the chargeable transfer. But there's one main difference between the two, and that is that we deduct from any transfer of value, whether it's a PET or whether it is a CLT, we deduct from the PET or the CLT the lifetime exemptions. And that's what eventually now we've come to see in this particular section here. In section 7, we deal with lifetime exemptions. So be aware, the deductions that we're seeing here will be deductions from the transfers of value made in lifetime, i.e. when dealing with either PETs or CLTs. None of these deductions apply to the death estate. Do not go deducting any of these exemptions from the death estate. They are purely lifetime exemptions. Okay, so as we've just said, back at the beginning and in illustration 1, we computed the transfer of value, but then thereafter, we have been taxing the chargeable transfer figure. The chargeable transfer figure, as we've just said, is computed by deducting whatever these available lifetime exemptions are from the transfer of value. Now, the only exemption we've been introduced to so far is an absolute exemption, which of course is any transfer between spouses or civil partners. There are no limits on that, but if any spouse or civil partner transfers to the other spouse or civil partner, those transfers, whether made in lifetime or on death, they are exempt. But now these specific exemptions that are applicable to the lifetime transfers. The ones that we're going to see to begin with, these two here, the following exemptions are available against lifetime gifts. So these will be deductions away from the transfer of value to give you the chargeable transfer figure. First of all, what will always be applicable each tax year, again, will be, well, we're used to the concept, aren't we, of an annual exemption. We have an annual exempt amount in terms of CGT. We have a personal allowance in terms of income tax. Well, here we see we have an annual exemption in relation to IHT. Now, this is a rather smaller number, and it's been this figure throughout. So whatever date you're dealing with in your question as regards a lifetime transfer, you won't have to look it up, though the figure will be given to you. The annual exemption is £3,000. So the first £3,000 of gift each tax year is exempt. It's covered by, it is reduced by this annual exemption. Any unused annual exemption is carried forward a maximum of 1 tax year for use after that year's own annual exemption. Now there's something that's different. With a personal allowance, with an AEA, an income tax and in CGT, we had that basic concept of use it or lose it. If you didn't use it in the tax year for the personal allowance, for the AEA, then that was lost. You have another one next year, but you didn't get to carry forward any unused amount from this year. Well, here in terms of the IHT rules on the annual exemption, we do get to carry forward any amount, or all indeed of, but any unused amount of the annual exemption from one tax year to the next tax year. We only get to carry it forward for one tax year. It's not a huge giveaway, of course, given that the amount involved is only £3,000 per annum. The exemption then is allocated to gifts on a strict chronological basis within the tax year. On a strict chronological basis within the tax year. So whichever transfer comes first in the tax year, again going from 6th of April to following 5th of April, it will benefit from the annual exemption. So if we've got a pet in June 2020 and we've got a CLT in October 2020, June 2020 comes first. Before October 2020, the pet in June will take the benefit of the £3,000 annual exemption. If that transfer of value was less than £3,000, say it was only £2,000 of course, then it would use up £2,000 of the £3,000 annual exemption, meaning there'd be a nil chargeable transfer figure for the pet, and the balance unused of £1,000 would then be available against the October 2020 CLT. But if any amount is unused for the year, so if, for example, we have the June 2020 pet, but that was the only transfer made in 2021, we'd have used £2,000 out of £3,000, we'd have an unused annual exemption from the 2021 tax year of £1,000 to carry forward for use in the next tax year. Well, it's carried forward from 2021, obviously, to 21-22. So that means in 21-22, in terms of chronologically the first lifetime transfer that comes along within that next tax year, we have available both the annual exemption of that year, 21-22, and also the unused annual exemption. In my little example there, we said £1,000 from the 2021 tax year. And that's where it is important to know the order in which you will use those exemptions. And as the rule says here, the annual exemption, if unused, is carried forward a maximum of one tax year for use after that year's own annual exemption. So as we'll see in an example that follows on here, just a little bit further down the page, as you'll see, what we will have is when that first transfer comes along in 21-22, we will use the annual exemption, or AE as we'll know it from now on. The AE for 21-22, we'll use it first. We use the current year's annual exemption first, before then using the unused annual exemption brought forward, if there is one, from the previous tax year. Now, although you might like to use it the other way, you can't. So remember, for the first transfer in the tax year, you use firstly the annual exemption for that tax year, and if it exceeds £3,000, this transfer of value, you would then start to use up any unused annual exemption from the preceding tax year there. It must be done in that order. So those will be deducted from the transfer of value to give you, if there's something left over, the chargeable transfer figure. And when we've dealt with pets or CLTs in the examples that have gone before this, it is that chargeable transfer figure after those exemptions have been deducted that we've been talking in terms of. If the transfer you're looking at is a pet rather than a CLT, then this one may be applicable, the marriage exemption. And if it is applicable, then it will come first before the use of the annual exemption itself. You will always use this specific marriage exemption before then, if the transfer of value is bigger than the marriage exemption, before then going on to use the annual exemption for that tax year, and if then necessary of the preceding tax year brought forward unused, of course, to this year. So marriage exemptions, if applicable, will be used before any annual exemption. It will, of course, be a gift in consideration of marriage. And of course, wherever we see marriage, we also mean civil partnership. Is exempt up to certain limits. And this will be dependent on the relationship of the donor, the person making this gift, whose IHT computation you are dealing with. It will depend upon the relationship between the donor and the donee, the person who's effectively getting married here. For each of the parents of the bride or groom, the first £5,000 is exempt. So, to your child, both mother and father, both spouses or both civil partners, as the case may be, are able to give £5,000, and that will be covered by the marriage exemption. So if in a tax year an individual gave £8,000 as the one and only transfer to their son or daughter on the occasion of their marriage, all £8,000 would be covered by exemptions. The first £5,000, the marriage exemption first, £5,000 because we're dealing with a parent of the bride or groom there. The first £5,000 is exempt. We would then still have a further £3,000 of the transfer of value, otherwise chargeable. But if this was the first transfer, or simply the only transfer made in the tax year, as I suggested, then we would then apply the annual exemption of £3,000. If, of course, the transfer had been £10,000 made by this individual to their son or daughter on the occasion of their marriage or civil partnership, then we would be talking in terms of, firstly, the £5,000 marriage, followed by the £3,000 annual, £8,000 in total away from 10, leaving a chargeable transfer of 2. So again, it is the relationship of the donor to the donee that matters there. The giver, that is the person who's getting the benefit of this annual exemption. The person it's being given to is either it is on the occasion of, so this means the transfer is made before or at the time of either the marriage or their civil partnership. For remoter ancestors, for example, grandparents, great-grandparents, so direct lineage here, and for the parties to the marriage themselves, the exemption is £2,500. So any grandparent or great-grandparent, if they are so desired of doing this, are able to give £2,500 to their grandchild or great-grandchild on the occasion of their marriage or civil partnership, and that transfer of value made by that grandparent or great-grandparent, that will have deducted from it the annual exemption, the marriage exemption of £2,500. Clearly, if they go above the marriage exemption, do they then still have available for this tax year either the annual exemption of the year or any amount brought forward from the previous year? But these marriage exemptions take priority, and the amount available depends on the relationship of the donor to the donee, the person whose marriage or civil partnership it is. Are we talking about a parent to that individual? Are we talking about a grandparent or great-grandparent? If we're talking about anybody else, for others, the exemption is £1,000. Giving to your niece or nephew or cousin there, whoever it might be, £1,000 is the marriage exemption. When we looked at the £2,500 exemption a moment ago, we said, though, that that was for remoter ancestors other than parents. We are talking, therefore, about the grandparents, the great-grandparents, etc. But we also said, and for the parties to the marriage themselves. So you might be thinking, hang on a minute, transfers between spouses or civil partners are exempt anyway, so what's this? But remember, when this transfer is taking place, this transfer is prior to or on the occasion of their marriage. So it's before they're married, before they are civil partners. Hence, therefore, what that means, guys, you'll be really pleased to hear this, that if you want to spend £2,500 on the engagement ring there for your to-be wife, your fiancée as now she would become, that there'll be no IHT implications. I'm sure, ladies, you'll be interested in that as well, so that you'll be able to tell the husband-to-be there that he will be able to afford to spend £2,500 on that engagement ring, or indeed a glorious wedding ring, as the case may be, and have no worries about IHT. Well, he'd be hoping to survive for 7 years anyway, I would trust, irrespective of that particular fact. But those figures of 2.5, be it the remoter ancestors, or be it, again, the spouses or civil partners themselves, we're talking about something happening before the marriage, on occasion of that marriage. After they are married, then of course spouses or civil partners can make any amount of transfer between themselves, and all such transfers will be exempt. Now, those exemptions there are the main two that we'd ever have to deal with, and they are deductions, as we said, from the lifetime transfer of value in coming down to, if there is any positive balance remaining, what will be the chargeable transfer figure. It is the chargeable transfer figure that you then use within your IHT computation. If we're talking about a CLT, to be used within the computation for lifetime transfers chargeable when made, and then again lifetime transfers chargeable on death. If it's a pet, it is only the lifetime transfers chargeable on death computation that will of course involve that figure of pet. These exemptions, firstly marriage if available, and then annual exemptions. So again, if it was a marriage, marriage first, then annual exemptions, as we just said, are deducted from the transfer of value to compute the amount of chargeable transfer. So before you can do any of the IHT computations, the lifetime transfers chargeable when made, the lifetime transfers chargeable on death, moving on to the death estate itself. Before any of those computations can be done, you need to know for the lifetime transfers of value, whether PET or whether CLT, what is the chargeable transfer figure? What is the amount to be included within the relevant IHT computations? Now, those exemptions there, as we said, are deductions from the transfer of value. Slightly different to the last set of exemptions we have to do here, where these exemptions, if available, will fully exempt the transfer. So what are they? Firstly, a figure for which we have a specific number, a small gift. And a small gift is classified as being gifts of up to £250 per donee. Remember, we're dealing with a cumulative donor-based tax. We're dealing with the donor. But if they make 1 or 100,000 individual lifetime gifts to one or more, maybe not 100,000, but one or more individuals, then each such gift up to £250 is exempt. But this is an absolute exemption there. We do not deduct £250 from a £300 gift. If the lifetime gift made to this one individual in total for the tax year is a total of £300, irrespective of the fact that one figure, the first lifetime gift to that individual in that tax year was £200, but in the same tax year made another gift to that same person, £100, the total per donee for that tax year, that's exceeded £250. So neither of those two gifts will class as being exempt under the small gifts exemption. Gifts of up to £250 per donee per tax year are exempt. But as we've just said, if the limit is exceeded, that exemption is lost. So you make a gift of up to £250 to any number of different people in total for any given tax year. Every one of those figures will be exempt under the small gifts exemption. But if you go over an aggregate total to one person in a tax year of the £250, you go over that figure, then all of those transfers, like if it was £200 in June and it was £100 in December, 200 for the birthday, 100 for Christmas or whatever it might be, then neither of those are covered by the small gift exemption because the aggregate, the total for the tax year, has exceeded £250. So with these, it's all or nothing. Either that gift is exempt or it is not. There's no deduction of £250 from whatever the gift may have amounted to. We've then got less likely ones, and maybe more likely for a narrative exercise, should you ever get one, but gifts for family maintenance. Any gifts made to maintain family members are fully exempt. So if you're looking after elderly parents or something like that and you make gifts to them, any such gifts to look after them for family maintenance those would not classify as chargeable transfers. That exemption would apply. And then, well, normal expenditure out of income. Now, there again, you'll see no figure placed on this. What is normal for one person is not normal for another. What is normal to the likes of you or I is very different to what might be normal for, say, the Duke of Westminster, whose income each year runs into the multi-millions there. So, this normal expenditure out of income, for this exemption to apply, the donor must show a regular pattern of giving. So it's not just on a one-off gift. It must be a regular pattern. It's like their birthday presents, their Christmas presents. It's normal expenditure. Out of income. So the donor must have enough income left to retain their normal standard of living. It makes it difficult, therefore, in an objective testing exercise, which is likely to be what you've got to deal with here in Section B or in a Section A IHT question. It's difficult to test out that particular issue, other than here's a list and the information supplied is sufficient for one of those on the list to be deemed to be normal expenditure out of income, and therefore it is an exempt transfer. We've now got our little illustration to illustrate what is now that process of working from the transfer of value down to the figure of chargeable transfer. Now again, when it comes, as we'll see in maybe the next lecture, but certainly a later lecture, when it comes to our approach to exam questions, we are likely to see the 10-mark IHT exercise in Section B. So it's going to be 5 individual objective testing questions. Now, we'll see a makeup, therefore, as you move you through the question. So the first question might be to work a transfer of value. Now, that, to make it interesting and therefore worthy of 2 marks, would be likely to be some gift of some of your shares in an unquoted company. So you have to do that exercise of what did I have before, what did I have after, and the difference is the transfer of value. Or the question is asking you for the chargeable transfer. Now, that could be a separate question, because then having got the transfer of value, you then need to establish, well, what exemptions are applicable to be able to work the chargeable transfer. Or they just ask you for the chargeable transfer. Transfer of value, less. Now then, the only deductions from the transfer of value that you'll see would have been those first 2 exemptions, as we were told here, the annual and the marriage. So they are much the more likely for you to be tested on, and you may very well have to apply both. Because what we may see is that the transfer of value for the individual, the donor concerned, is greater than the marriage exemption. As we said, parent gives £10,000 to their child. A parent gives £10,000 on the occasion of the child's marriage to that particular son or daughter. So what have we got? £5,000 marriage. If it's the first transfer in the year, or the only transfer in the tax year, we've got a £3,000 annual exemption, leaving you with just £2,000 chargeable transfer. If there was an earlier lifetime transfer within the tax year that had already used the annual exemption, then we'd only have the marriage exemption of 5 to put against the 10, thus leaving a chargeable transfer of 5,000. So we'd need to compute that. We've got a rather more interesting exercise here, where in illustration 13, we've got to compute the chargeable transfer figure for each of the following lifetime transfers. This will involve knowledge of what I've just said, and knowledge that precedes it, but I've reminded you of during this most recent discussion. So what have we got? And also, we'll look at the framework of our answer. We are going to deal with these transfers in chronological order, as we've done with our PETs and CLTs before this, with a column for each based on whatever their dates may be, and whatever the type of transfer may be, which of course, for a lifetime, a chargeable transfer, in lifetime, for it to be chargeable, it's either going to be a PET made within the 7 years of the date of death, or it's going to be a CLT. So we'll have the date and we'll have the label. And then, as we've said, we work from the transfer of value, taking away the deductions we'll see, unless any other exemption applies, will be the deductions there will be, marriage exemption, annual exemptions there. And that will bring us down to the chargeable transfer figure. It is then, well, that's nil and that's nil, so nothing to worry about there. But these are then the figures that would feed into your respective IHT computation. That is only 3,500, but that is a PET. That would only go to the computation headed lifetime transfers, chargeable on death. This one is a CLT, and is a much more interesting number, £100,000, a transfer into trust, of course, here. And that one would go both to a computation headed lifetime transfers chargeable when made, as well as being included on the lifetime transfers chargeable on death. The chances are, of course, for you to move to such an IHT computation, the numbers will be rather greater than the ones you see here. Otherwise, everything would just be covered by your available nil rate band, and that's not going to happen in terms of an exam question. But what this tests out is, do you know not just what the exemptions are that are available against these lifetime transfers of value, but also, of course, the order in which they are applied. So as we read the question, knowing that's the chargeable transfer figures we need to compute, what do we pick up? On the 7th of June 19, a gift to her daughter of £2,000. A gift to her daughter. What type of transfer is that? That, we should know, is of course a PET. Which is why 7th of June 19 is headed there as a PET. 12th of August 19, a wedding present to her son of £5,500. A gift to her son. That again is a PET. A gift to her husband of £20,000 in September 19. That gift to the husband, well, that's neither a PET or a CLT, is it? Because that is a transfer between spouses, and it is exempt in its own right. It doesn't matter how much is involved, whether it's £20,000 or £2 million, that is an exempt transfer. 9th of July 20. A gift to her nephew as a wedding gift of £8,000. Again, a PET. Gifts of £200 each to 2 friends as a Christmas gift on the 25th of December 2020. Now then, £200 each to 2 friends there. 200 does not exceed 250, so that is a small gift. So we'd immediately think that the small gifts exemption will apply, and indeed it will apply here. But be careful, because what we then need to see is if that was the 25th of December 2020, so within the 2021 tax year, were there any further gifts in that same 2021 tax year, so before the next 6th of April to the same friends. And if those amounts, if there were any, took you over in total for the tax year to 50, then there'd be no small gift exemption. But the only remaining transfer, which is indeed in that 2021 tax year, is a gift to a trust. And that, therefore, as you know, is going to be a CLT. So those £200 each to 2 friends, both of those gifts will be exempt. And why are they exempt? That is the small gifts exemption that will apply there. The small gifts exemption. Right. So that is what told me that I need these 4 columns here. For these transfers, PET dated June 19, PET dated August 19. We then got, well, that's exempt, PET again dated July 20, and a further then CLT March 21. That's what created those columns and these labels here. We then need to know the transfers of value. Well, we know the transfers of value. It's given £2,000, £5,500, £8,000, and here 100,000. So that's just a copy in from the question. There was no work to be done in computing there, whatever the figure of transfer of value might be. Had one of those gifts been some shares in an unquoted company, we'd have had to have done what did he have before, or what did she have, as the case may be. What did they have before? What did they have after the transfer? But that wasn't the case here. Again, as reading the question and knowing what this was all about, you could at the same time, having recognised, are they PETs, are they CLTs, or are they simply exempt transfers? In relation to the PETs and CLTs, have we got an annual exemption to apply? Have we got a marriage exemption to apply? So you got there June 19. Now remember, on the annual exemptions, we go by tax year. So if you've got a list like this, it would be useful to break that up into tax years. So they're the first 3. They're dated June 19, August 19, September 19. So all of those are in the 1920 tax year. We've then got July 20, December 20, March 21. All of those are in the 2021 tax year. So it would now be a question of seeking to apply the relevant exemptions. Now I know the answer is written underneath, but if you can avert your eyes from that for one moment, what you should have done by now is, having read through the information of the question, identified these 4 columns here as we keep pointing to. We know the dates of the transfer, we know the type of transfer that they represent, and we also know the transfer of value. We also know that the first 3 transfers, though you are not necessarily interested in all of them, but you know that they fall in the 1920 tax year and the last 3 fall in the 2021 tax year. That's going to better enable you to determine the annual exemptions that will be applicable. But remember, before you apply an annual exemption, any marriage exemption would apply first. And there it's down to that relationship between the donor and the donee. Okay, pause just for a moment while you attempt to try to correctly make those deductions. There's no necessarily a need for you to write them out as such because you can see it on the page in front of you. But as I said, try to avert your eyes and think it through from yourself. So just looking at the information in the question. First up in the 1920 tax year is June 19, a gift to a daughter of £2,000. That is a PET. What deduction will be applicable against it? And given the amount involved, what then happens with the next transfer? And then subsequent transfers as you go through chronologically those 2 tax years worth of transfers. Okay, over to you for a moment, pause here, and then obviously I'll take you through it. Okay, so let's see how we've fared here, therefore. First up was the 7th of June 19 transfer, it being a PET, the transfer of value a mere £2,000. It's the first made within the tax year, therefore it benefits from the annual exemption for this tax year, the 1920 tax year. That uses 2,000 of the 3,000 available. Now then, there was no mention of any earlier transfers having taken place, and that therefore may very well mean, it may be more explicit in another question, that there were no transfers in the preceding tax year. So back in the 1819 tax year, there was no such lifetime transfers, which would mean that we have an unused annual exemption brought forward from the preceding year. Remember, it can only be carried forward 1 year. But of course, we only use any brought forward unused annual exemption after firstly using the current year's own annual exemption. So that annual exemption of 1920 tax year is first to be applied. That is 2,000. That immediately removes that transfer of value. So we've got, as we noted before, a nil chargeable transfer. On to the next transaction within this tax year relevant to us, and that was a wedding present to her son of £5,500. So again, August 19, the pet, £5,500 to her son on the occasion of the son's marriage. Therefore, the marriage exemption, how much went to your direct descendant there, your son or daughter? £5,000. The transfer of value is 5.5, so after the marriage exemption has been used, which now it has been, any further transfer of value remaining chargeable, we can now revert to our annual exemption. Again, looking at do we have any unused annual exemption of the current tax year to begin with. And the answer to that is yes, we do. We have already used 2,000 of the 1920 tax year. That left 1,000 unused. We've only got a further 500 to apply there to again bring down that figure of transfer of value to a nil chargeable transfer figure. We then move forward again, and the next relevant date for this computation is July 2020, a pet of £8,000. What was that? A gift to her nephew as a wedding gift of £8,000. I'm sure that will please the son. Obviously, she likes the nephew more than her son. Going to be a problem there. But what have we got? £8,000 marriage. Marriage exemption first to apply. It's to her nephew. So this therefore is not to son or daughter. It's not to a remote ancestor in terms of grandchild or great-grandchild. So on that basis, therefore, the only marriage exemption available is that £1,000 to any other person, whether a relative or just a friend, doesn't matter, to anybody other than the ones specifically prescribed for your £5,000 and £2,500 worth of marriage exemptions. Anybody else is £1,000. So that's 1,000. So we now look to use, after the marriage exemption, the annual exemption. Which tax year are we now in? July 20. Well, that's 2021. So all of the 3,000 annual exemption for the 2021 tax year will be consumed by this pet. But because there's still transfer of value remaining chargeable, we've got to look now to see, do we have any unused annual exemption brought forward from the previous tax year? The answer to that, which hopefully you've already seen for yourself, is yes, we do. We'd used £2,000, a further 500, so 2,500 in total, had been used within the 1920 tax year itself. So we've got brought forward some £500 to now apply there. Clearly, we're now in 2021. Any unused annual exemption from 1819 could only have been carried forward for 1 year. It was only usable within the 1920 tax year. It didn't get used here because it's used after the annual exemption of that current tax year. So there's nothing else to come forward. That is it. So at last we have a chargeable transfer, having made here a deduction of marriage exemption of £1,000, 2 lots of annual exemption, current tax year 2021, the full £3,000, and the remaining final figure of £500 brought forward from the 1920 tax year. We move forward but stay within the same tax year to March 2021. That therefore being in the same tax year means there's no annual exemption to go against it. It's a transfer to trust, so there's no other possible exemptions that could go against it. So that transfer of value is indeed the same as the chargeable transfer figure there. They are one and the same. There's no annual exemption to go against that. Just have a little read through the points I've been saying there, but within those notes there. Just have a little read through for yourself on that just for a moment. Make sure that we're comfortable with how it is that we get the transfer of value in the first place, and then from the transfer of value down to that bottom line chargeable transfer figure. Okay, well, hopefully no problems there for you. We're looking now at what will be next up in terms of our next lecture together, looking at the approach to exam questions. It's going to be time to bring together all of the technical facts that we've seen and look at what would potentially be an exam question in terms of, as a complete entity, what exercises would we be required to do? Talking about a Section B question for some 10 marks, albeit it would be broken down into 5 individual 2-mark objective testing questions. And that means that I need you not only to go back and revise all of the things we've done so far. We've just been talking about chargeable transfers and how we firstly get a transfer of value, take out the lifetime exemptions, come down to chargeable transfer. We also need to know about, having got a chargeable transfer, what computations do they go into? If any of them are CLTs, like in the previous example, then that demands a computation, the first of the IHT computations for you to do, headed Lifetime Transfers Chargeable When Made. Once that one is done, looking at the date of death of the taxpayer, that demands next Lifetime Transfers Chargeable on Death. What is included there? How do we put that computation together? Go back, revise those computations. For lifetime transfers chargeable when made, just your CLTs, lifetime transfers chargeable on death, both PETs and CLTs there. Once those are done, then you can move finally to your chargeable estate at death and deal with its computation, working out any amount of IHT that is then payable as a result of the death of the taxpayer, and indeed, if necessary, stating when tax is due to be paid, not just in relation to earlier lifetime transfers, but of course specifically then to the estate at death itself, and the lifetime transfers becoming chargeable on death. We'd be able to state when would the tax be payable, who would be responsible for paying it, and who would be the person or persons bearing the cost of that tax. Go back, revise all that, read through this. I will take you through it next time, all of which will then be as a prelude to having a go at some exam standard material questions. So, lots of work for you to do therefore between now and next time.